What to look for when buying and selling cryptocurrencies. When investing or trading cryptocurrencies, or simply just investing and trading in general, you want to allocate core holdings depending on your risk tolerance. Starting out, you should dedicate the majority of your portfolio into these core holdings. Up until 2016, early 2016, there was really only one choice for holding cryptocurrencies. You held Bitcoin if you wanted to be involved in cryptocurrencies. You had a few clones with minor tweaks, but really there wasn't much else to invest in. Ethereum came along in 2016 and kind of changed the marketplace. It has since evolved and grown with new platforms launching every week. ICOs happen every day. With tens of thousands of coins to choose from now, it's still the wild, wild west, and it can be daunting to pick your first investments. For newer investors, it's really best to keep a substantial portion of what we consider larger market capitalization coins. They're typically lower risk. Market cap is not very indicative of the market. It's easily gamed and cheated, but it's the best thing we have right now to assess these coins. These have the highest volume, typically have the highest trading volume, and the lowest level of volatility in comparison to other coins and tokens of the marketplace, not compared to traditional markets. Having an established base of developers is probably the second most important from a longevity standpoint. A starting point could be, you could have about 50 to 70% of your portfolio in these assets. As you research and, get a better feel for this space, you can move your allocation into more speculative projects. But generally, these are Bitcoin, Ethereum, Litecoin, Neo, Monero, larger market capitalization with a strong developer base. And then you can also think of it as sectors. So as of now, the most of the volume in terms of market cap is created on the protocol layer, with about 70% of the market cap related just to Bitcoin and Ethereum alone. One could also classify Bitcoin as an application, though, but its share of the market cap will significantly decrease over time. The more applications that are built on top of these underlying systems, the more users become part of the networks, the more the underlying token gains value. Thinking in terms of different sectors is also a good place to start, though. Just as traditional finance, there are projects that fall into different concepts and goals. Thinking about how much your portfolio is in each segment is correct risk management. So pretty much the first sector we kind of broke down is these are platform coins and tokens. So these are technology platforms that other things can be built upon. Decentralized applications that can be built upon. Some examples are Ethereum, Neo, Arc, Lisk, Request, Bitcoin, and Aeon. So those are just a few of the more popular ones. We typically hold a large amount of the portfolio in these, 50 to 70%. And then next we have the privacy specific. So a lot of those platforms and currencies that we listed before don't have privacy natively built in. The technology is just not there yet, and the stage of development we're at. So these coins focus specifically on privacy, private transactions, and computational applications. The major platform and currency coins have yet to implement, the privacy solutions like these ones we have listed: Enigma, Zcash, Monero, Pivx. These are just some of the more popular ones. And then we have enterprise-specific coins and tokens. So these projects focus on building solutions for institutions. They're typically seen more safer investments due to partnerships with existing companies. So these are existing companies with track records that have invested a lot of money into these tokens to build solutions for their business. Something like Ripple, Stellar, Neo, Walton Chain, VeChain. I would allocate a smaller amount here simply because they're not very disruptive. They won't really change the world of finance, but they'll be successful because of the backing they have. Then we have currency-specific coins. It can kind of be put together with platform coins, or privacy. They kind of fit. A lot of these coins you'll see will fit in multiple different sectors. While yes, all other cryptocurrencies are essentially used for financial transactions, these are solely created to be a medium of exchange and store of value. Things like Bitcoin, Litecoin, and Dash. And then this is where it gets fun, promising new technologies. So as experimental as the current range of projects I've been listing are in the space right now, there are even more on the edge of those. So on the edge of innovation compared to those. So as experimental as everything else is, these are even more experimental. Bitcoin, for instance, has been around working continuously for over 9 years without a single second of failure, which is amazing. And that's why you hold majority, at least half of your portfolio in Bitcoin. In comparison, there are projects out there that are reinventing what Bitcoin aims to solve. If it's going to be successful, no one knows yet. And they've only been live for months instead of 9 years. So some of these examples are IOTA, Cardano, and Nano. So IOTA and Nano are really trying to do what Ethereum does in the platform coins. They're more promising. And then you have things like I misspoke. So IOTA and Nano are more currency-specific coins, while Cardano and EOS are platform-specific coins. There is another way to view these cryptocurrency sectors, though. So we broke them down into one way, and these are kind of another way you can look at it. There are so many different ways, just like traditional investing in markets. Every investor has different ways to look at things. So you can take a look at infrastructure coins. So looking at the current market capitalization of cryptocurrencies, like we talked before, most of the value is in the base layer infrastructure. About 65% of the total market cap is made up of these infrastructure layers. These projects are the base layer in which developers can build cool things on top of, basically. They solve the basic functions of money and financial transactions, and the more applications that are built on top of these systems, and the more users become part of the project networks, the more the underlying token gains in value. The majority of price action is still based on speculation, though. So traders tend to view the value as how big of a network the coin has. They pull data from GitHub, number of nodes, miners running, transaction amounts, and just general sentiment. This can be all added together in what is typically called the utility value of a coin or token. Some examples are Bitcoin, Ethereum, Tendermint, Neo, Lisk, Ripple, IOTA, Zcash, and ARK. Holding a majority of your portfolio in these coins of utility value is a good start. For the crypto asset space to be successful, for this entire space to work and be adopted, these base layer coins need to be mature and well developed. And along with that, your price will increase. So being in which everything else is built from, they're typically the most stable and won't fluctuate as a single project on top would, because we see project teams disappear from initial coin offerings, ICOs, every day. But with Bitcoin and Ethereum, there are tens of thousands of developers working on it. Tens of thousands compared to half a dozen for a single project. So in cryptocurrencies, the best way to gauge the safety and longevity for a project is to look at the developer network. Follow where the talent is. And then next we kind of go to the middleware. So you have the base layer, then you have the middleware. Between the basic level infrastructure and the end level, which is the decentralized applications or dApps, there's a whole spectrum of software built to mend them together. For instance, you have the whole decentralized computing and storing like Golem and Sia coin. With these coins, we have something in which a developer can build the final stage of application on top of. Some examples are Golem, Sia, Civic, Augur, File, MetaMask, ZeroEsk, Enigma, and Request Network. So like I said, some of these can kind of fit in the other sectors we talked about before. And then the final, at the very far edge of the ecosystem, we have specific applications. At this level, you'll see the widest variety of choices. The potential use cases are only limited to the imagination of these development teams. They range from replacing online ads to changing the way governments even function. So a few examples of these sectors are basic attention tokens, Steam, Binance Coin, Funfair, Factom, Power Ledger, Salt. So these are generally viewed as more risky than the underlying and middleware technology because these applications have a very focused vision and very limited teams. So a very focused vision is they can be disrupted very easily. Something from regulation can hit them. So, as a general rule, really only invest and trade in whatever sector you understand, sector or layer you understand. If you haven't researched how enterprise platforms function, for instance, then way less capital into them. Or maybe you love tech and you spend all your time researching the latest advancements. Then allocate more towards the experimental. The point I'm trying to make here is that you should try to invest your medium and high risk picks in a segment you understand very well. You should be able to better judge the risk of these projects because of that. So figure out what your goals are, and what your risk tolerance is, and how you plan to construct a portfolio to achieve those goals, rather than just chasing the hyped coin of the week. This will allow you to take some of the motion out of investing and trading.